Can I let you know a secret? I quit traditional retirement planning, and maybe you should as well. People are often surprised to hear that there are several ways for a financial advisor or for you as a do it yourselfer to come up with a safe withdrawal strategy from your retirement accounts. And in fact, I'm going to share with you this article. It's written by Kathleen Coxwell, and it's called Retirement Income Strategies 18 ideas for lifetime wealth and peace of mind. And that second part is really important because that's what we want in retirement. We want peace of mind. We don't want to be staying up at night wondering if we have enough money. So in today's video, I'm going to share with you the strategy that I'm using for myself and much of the industry, much of the professional industry. I'm now retired. I was a financial advisor for over 20 years, but much of the industry is moving towards this because it allows people to potentially spend more money in the likelihood that the market goes up during your retirement. But it keeps safeguards in place in case you're unfortunate and the market goes down early in your retirement years. That's really what financial advisors are trying to protect you from, what we call sequence of return risk. It's a real risk that early on, when your nest egg is the largest, that the stock market does poorly. So let's dive into Kathleen's article, and then I'm going to tell you more about the strategy that I and many of my peers that are still working are converting towards. Okay, the first strategy is retirement income strategy one, which is based on buckets. So buckets are, this is money that you're planning on spending maybe in the first 2 or 3 years. There's another bucket that's for intermediate term, maybe 3 to 7 years. And then there's a third bucket designed for long-term growth. Maybe that's all the money that you don't need during those first 7 years. So you've got your first 3 years, stable, secure, money in the bank, U.S. Treasuries, very secure, high credit quality, short duration, corporate bonds, things like that. Then in your medium bucket, maybe that's 30% stocks, 70% bonds, whatever that mix is. So it's lower risk, and you don't have to worry about, or you don't have to worry as much about the volatility in the market. And then the third bucket is designed really for long-term growth. So that's the first one that Kathleen mentions. The second one is separating, it's kind of a derivative of the first strategy, which is separating your needs from your wants. So you would have a bucket that is conservatively invested for your needs, paying your rent or your mortgage, putting food on the table, groceries, paying for fuel for your car, maintenance for your home, things that are necessities. And then in your wants would be another bucket, and that can have more volatility associated with it, maybe be exposed to the stock market more, because that's something that's discretionary. We want to do it, but we don't have to do it. So that's the second one. The third one is what Kathleen calls systemic withdrawals, fixed percentage withdrawals. And that's your typical 4% rule. You decide on whatever the number is. A very common rule in my industry is the 4% rule. You index that for inflation every year, and in a portfolio that's exposed 60% to stocks, 70% to stocks, and the rest to bonds, there's a very high likelihood that over a 30-year period, you will not run out of money. Now, Kathleen's article has 18 different strategies. We're not going to go over all 18 of the strategies. You can look up the article, just pause the video and look it up online. But I do want to talk about what Kathleen lists as number 4, which is build guardrail strategies. So what are guardrails? Guardrails are looking at your distribution rate and saying, there's probably a safe range that people can take out. I mentioned earlier the 4% rule. Well, that might be a good number, but a lot of people end up not touching the money that they put aside for investments. In fact, BlackRock says that over 80% of retirees 17, 18 years later, or I should say, of retirees that BlackRock has in their survey, still have 80% or more of the money that they retired with. And that's very common. There are multiple studies that have shown that people don't spend their money, and we don't spend our money because of the uncertainty, the unknown. None of us want to be 85, 90, 95 years old and run out of money. I don't want to see that happen to you. And it's one of the reasons financial advisors are conservative, mea culpa. I never want to see any of my clients have to deal with that issue back when I was working. And so we take a more conservative approach. But is there another way to take a conservative approach and give people the confidence to spend the money? And that's what this guardrail process is. Uh, and essentially, let's say that instead of starting at 4%, you started at 5%. Now you're going to have a higher chance of running out of money. So, how do we protect you in that case? Well, we put guardrails up. Let's use an example to illustrate this. Let's say you start with a $1 million portfolio. And as I said in this example, you decide to take 5% off. Nothing I'm sharing is financial advice. I don't know your situation. If you like this strategy, I urge you to do more research on it, but I want to put this on your radar screen. So $1 million, we're starting off spending 5% a year, $50,000. But if that $50,000 starts to represent too much money out of the portfolio, we want to protect ourselves. Lower guardrail is, what if it becomes too much? Now, this is what we're worried about. If your 5% withdrawal rate becomes 6%, that might be too much. And so we'd want to bring you back down. So in this case, if $50,000 is 6% of your portfolio, then I just take the 50,000, divide by 0.06, and I find out that the portfolio value would be 833,333. So if the year-end value, or whenever you decide to take that distribution, drops, if your year-end portfolio value drops below $833,000 in this example, we're going to readjust and we're going to take 5% again of that $833,000. And if it goes up above the $1.25 million, then we're also going to say, hey, that's only 4%. So let's take 5% of that $1.25 million, which is going to be more. It's going to be $62,500. It seems complicated. You can rewind this. And it can be complicated, which is why I encourage people to work with a fiduciary financial advisor. I know a lot of folks aren't going to do that. If you aren't going to do it yourself, I urge you to not try to do these types of calculation in Google Sheets or Excel. It's just too easy to make a mistake. The software that I like is called Bolden. You can find Bolden at this QR code or in the link in the description. This video is not sponsored by Bolden, but I am an affiliate, so you'll be helping out the channel by doing that. Again, watch this video over to get the concept, but doing a strategy like this may allow you to spend, instead of 4%, 5%, and that is 25% more money each year. And more importantly, I want you to have the confidence that you can safely and securely spend the amount of money that you're budgeting for. And that's why I like the guardrail approach. Again, I'm not saying 5% is the right number. You've got to do the math. You've got to work with a professional. That decision is up to you. But I wanted to illustrate the concept and put the idea on your radar screen. If you like this video, the YouTube algorithm says this is the next video of mine, specifically for you, that you should think about watching next. Thanks for watching this one. Bye-bye.